about. So let's talk about the video I made today about my experience with Tesla investing this week. So any questions you guys have about trading options around Tesla, let me know. I was pretty honest in my video as far as why things ended up the way they did, right? Basically, all right, looks like I'm finally on. Let me see if I can see here. Okay, it says I have an excellent connection, but there's actually latency in the software that I can see here. All right. So let's talk about that, my Tesla experience this week, and let's talk about why that happened. And like I said, I got greedy. I've been not trading, but I've been selling call options on Tesla for a pretty long time. But call options that are really far out of the money, where the delta on that is usually like under 0.1. So under a 90%, or there's greater than a 90% chance in most cases that those options are going to expire out of the money, and I'm going to get to keep the premium, and I don't have to sell my stock. Now, I got kind of lucky that I did this in my IRA account, so it didn't trigger a taxable event of any sort. That was extremely lucky, because if I'd have done this in my taxable account, I have a lot of capital gains in there. Those would have gotten called. I would have basically had to sell the stock in that account. I would have had to buy back at a higher price, and I would have had to pay capital gains tax on 11 or 10 years of capital gains on Tesla. So this could have been a really, really costly mistake. Luckily, I only missed out on about $18,000 of gains. I was able to recoup a little bit of that through selling the cash secured puts. But because I did this only in my IRA, I was able to avoid tens of thousands of dollars in potential taxes that I would have to pay. So now, eventually, I'm going to have to pay taxes on my taxable account. You're going to have to liquidate at some point. You're going to have to start selling when you want to start enjoying those funds. That's a whole separate conversation as far as when you start liquidating. Like, I'm not in this business. I'm not in Tesla to trade Tesla. I'm in Tesla as a long-term investor. Somebody has a really super long-term view on this. Like, I made tons of money on Tesla by not doing anything. That's mostly how I've made money, by buying Tesla and not doing a damn thing. I'm going to tell you something that this has been discussed over and over and over on YouTube, but I have to mention this here. The sort of active trading culture that is going on with YouTube is trash. And I hope you guys understand that everything I talk about is not necessarily short-term and active trading. When I buy Leap securities, which are usually with, these are calls, deep in the money calls with maturities out, with, expirations date 1.5 to 2 years. That is pretty much the shortest term investment that I make. It's something where it's going to expire in 1.5 to 2 years. I don't buy, with the exception of trading a few meme coins, I don't do any short-term trading. I was tempted, and I did a little bit earlier this year at Tesla. Like I said, I think I've gotten a little bit greedy lately with how much money I've been making in Tesla. Like, I sold some out at like right around 800 and bought back at 770 or something like that. And this was maybe a month ago, but that's been going on for quite some time right now. And I'm not that short-term trading, but the fact that I don't do any short-term trading, when I say quite some time, it's basically been about a decade, really, since I've done a ton of short-term trading. So I've been in this business long enough, I've been trading long enough, I've been investing long enough to realize that most people who talk about trading, short-term trading, don't make any money. When I put them on the spot regarding how much money they're making, they can't prove to me how much money they're making over time. When I look at their account statements from people that I know are active traders through my professional practice, I know that they're not making any money on a short-term basis. So, yeah. So look, guys, there's a little bit of latency with the stream here. And Leo Wu, I want to say thank you to you. And you're a frequent contributor to my live streams. Hiker Dave 420 says, hey, from upstate New York. I like your videos. The video is a bit fuzzy. It can actually probably be more than fuzzy. My internet connection is actually what is not very good. My camera is a standard 1080p camera, but it's my internet connection that's probably not good. So Anvar H says, holding Tesla, tell that to Chamath and Toyota, especially that missed billions of profits because they sold their Tesla shares. Oh my God. Well, yeah. Well, I don't know how much. Chamath held, but it was quite a bit. But his reasoning for that was that he has other things to invest in. Oh, Leo Wu, thank you very much for your super sticker. I really appreciate that. My son was laughing at me last week when I was, bragging to my 11-year-old son about making $20 for doing a live stream. He's like, Dad, you make way less than minimum wage. I'm like, of course I do. Of course I make way less than minimum wage. So, yeah. So anyway, back to Tesla here and Chamath Palihapitiya. So, he says that he has other projects to invest in, and he is the SPAC king. He does need those funds to actually go through and create more SPAC opportunities with people. He's got to go through and go out and raise money, create liquidity pools to merge with different companies. I haven't heard or haven't really paid attention to what he's doing lately. I know that he's kind of pissed off a bunch of people lately with a few things that he said. That doesn't really happen with me. Like I don't get pissed off because of something that some celebrity investor says. I listen to what they have to say. I analyze what they have to say, and that's it. Invest with Jace says hello. Says, hey Jason, what's going on, man? I need to have you on here to do a live stream with me at some point, Jace. I'd love to help your channel out, help you get more subscribers. I know you're monetized and all that stuff now, but I'd love to help you out, and I think we can help each other out. So that would be great. Yeah, and if you watch that Tesla video this morning, then I screwed up. I messed up. Happy to talk about that. So Nicholas Morin says, I sold Tesla and bought back Nio. Do you think this is a good move? I think Nio has more chances to go up than Tesla at the present time. So I'm not sure that that's a better path to take in this case. In fact, Steven said something similar. Says, I think Nio is better than holding Tesla right now. Look, so Neo's always been a speculative investment for me. Like I bought Nio at under $2 a share, and I bought a lot of it. And just by happenstance, it's gone up quite a bit. I've made pretty good money on it. I trimmed my position a little bit last year, like back in December, because it had just gotten to be too much of my net worth. And I kind of left those holdings the same. However, going forward, I started selling covered calls on that because at this point, I am satisfied with how much money I've made on this. But generally, when I sell covered calls, guys, they are way out of the money, where I'm not making a ton of money on selling these covered calls. I'm just generating a little bit of income, and I reinvest it somewhere else. And it usually goes into my really boring, ETF portfolio, my index ETF portfolio. That's usually where it goes, right? But I'm satisfied that it blows through, my way out of the money call option that I sold, where it's like 15 or 20% above its current price. I'm making pennies per 100 shares here. If it goes through that, I'm fine selling at that price. Once again, some of this is in my IRA in a non-taxable account. Some of this is actually in a taxable account. I would have to pay now that I'm in the long-term capital gains, I'm into long-term capital gains. I've held it for longer than a year. I'm a little bit less concerned about taxation than I was before. But look, let's look at Nio. Like the advantage that Tesla has here in the US is that they have no competition, especially when it comes to competition in sedans. They really have no real competition. They don't have a problem with demand at all. They have a problem with meeting production, right? So basically, they've proven at this point that their demand is unlimited. No matter how many they sell, they can keep selling. And I think that the announcement that Hertz came, I think it was Hertz, came out with earlier this week, that they're buying 100,000 vehicles for their rental fleet. I think that's important. I think the more important part of that announcement is that 50,000 of those vehicles are going to be used as rental vehicles for their rideshare fleet, right? I think that is enormously more positive. That means that more and more people are going to be getting into Teslas and seeing Teslas in action, seeing how nice they are on the inside, seeing how nice the ride is, seeing how much of a technological marvel they are. This is the biggest advertising move that Tesla could have made. They don't spend anything on advertising. The fact that they got Hertz to use them as a as basically an advertising vehicle, I think is just absolutely genius, right? So they're going to be used by more and more people in the rideshare fleet. More and more people are going to be exposed to Tesla, and I think they are on an unstoppable upward trajectory. And Nicholas, also, if you saw my video that I made or my live stream last week where I talked about Tesla insurance, I really can't impress upon you. So I went back after that. I did that live stream and I was looking up the numbers for Geico, which is one of the largest insurance companies here in the United States. They do tons of like property and casualty insurance, and a lot of it's auto. And they do about $35 billion in revenues, right? Here's the advantage that Geico does not have that Tesla has. Almost everybody who buys a Tesla finances a Tesla. And when they do it through Tesla financing, right? And they finance that through Tesla. And when you buy a Tesla, they're going to offer you insurance. It's going to be part of the sales process that they offer you insurance. So not only are they going to offer you insurance, they're also going to have the most accurately priced insurance for the market, because they're going to give you an initial rate. Your rate is going to be adjusted based on how safely you drive. And now, I can't guarantee you, but I highly suspect that the more often you use their driver assistance programs, the lower your rates are going to be, because your collision rates are already lower with Tesla's autopilot. They're something like 6 times lower than human pilots. And no one else has the ability to accurately judge just how safe you are as a driver other than Tesla right now, because no one's actually collecting that data. And in particular, no insurance company is collecting that data, and they cannot accurately price. So you, as a really good driver, Nicholas, if you and I lived in the same state, you would be subsidizing me as a driver, because I'm a terrible driver, an absolute terrible driver. And it's just let me give you an example. Last Thursday, when I went into the gym, I stopped by at a store first to indulge my sweet tooth. Like, picked up a pack of M&Ms. I really hope that my wife isn't watching this. I picked up a pack of M&Ms. I parked in the store. I ran inside. I came back outside. Some guy screaming at me. He's like, hey, you, you're a crappy driver. You're a crappy driver. You should buy a Tesla. They have autopilot. And I was like, I thought that was a weird flex to like throw at me. But then I saw how I was parked, like all crooked and 25% in another space. I'm like, yeah, I'm a crappy driver, because I'm thinking about Tesla stock as I'm driving around, not necessarily thinking. Anyway, so I'm the perfect person who's going to benefit from that. You're going to subsidize me. So $35 billion a year is what Geico does in revenues right now. If really, I think it was Morgan Stanley just came out with an estimate. They think that that Tesla's only going to be selling by 2030. They're only going to be selling about 10 million vehicles per year, whereas Tesla thinks they're going to be selling 20 million vehicles per year, which would mean that their fleet of vehicles that's going to be in action at that point is already going to be 20 million by the time they're making 10 million a year, right? That's how many are going to be on the road by that time, right? Which means that, and they're going to be selling, if they sell half of the cars that they sell policies for as well, you're looking at a $40 to $50 billion a year business. Now, it's a low margin business, right? So Geico typically has a margin of about 5%. Tesla's margin will probably be a little bit higher. That's really the secret to their success, is they crush margins in everything. Plus, what people are forgetting about is the reserve pool that insurance companies have to have. Basically, for every dollar of claims that you might have, you need to have roughly $3 invested in a portfolio. That's going to be invested in stocks, bonds, real estate, mutual funds. So in 10 years with their insurance portfolio, Tesla, just like Geico, just like Berkshire Hathaway, is going to be one of the largest investment firms in the world, as well as one of the largest insurers, as well as one of the largest car manufacturers, as well as one of the largest, well, this is still up for debate, one of the largest providers of solar energy. I don't know if they're really gonna crack that nut, but I do know that they're gonna crack the energy storage business nut, right? So they're gonna be one of the largest car manufacturers, one of the largest energy storage manufacturers, a huge force in investing, really sort of the boring pension style investment where you're expected to make a return of 5 or 6% per year to support your claims pool, right? So, and I don't think people that watch my channel who don't have any experience in the financial industry or any experience in anything outside of tech investing and recent investing, they don't really understand just how massive and stable the insurance business is. This is going to be a giant driver of revenue for Tesla going forward to fund and expand other operations. So, do I think, Nicholas, and this is a really long-winded answer to your question, that that I think in the short term, Nio probably has better short-term possibilities to move up. In the long term, Tesla's going to crush Nio in terms of stock valuation. The disadvantage that Nio has is they have intense competition in China already with not only Tesla, but with VW and with all kinds of Chinese companies out there. So, so I do think that I don't think it's necessarily a mistake. I still think you're going to make money in the long term. I think, though, that holding Tesla would probably be a better idea. So, Leo Wu says Xpeng is the best. And look, you guys watched my video from last year. I think it was last year, right around this time, maybe a little bit later that I did my first video on Xpeng. Back then, I thought that Xpeng was a better buy in terms of how well they were capitalized, balance sheet, in terms of their how well they're controlling their their methods of production, how well they're vertically integrated. I thought they were a better buy than Nio at the time. The thing that I think that they don't have above Nio is branding. I still don't think that branding is super, super important. And I want to talk about that today in relation to SoFi. SoFi, and I'm going to get to this later, but SoFi is coming up on a couple of triggers here that one of them I think is going to cause a huge short-term bump in price and in membership. The other one is going to be a long-term monstrous winner for the company, and I need to talk to you guys and convince you guys how this is going to work. So, oh, by the way, that SoFi link is actually in my description. Somebody used it when I did my last live stream. Thank you very much. I think that was Epic Hamster that used that, and I've already gotten that $25 stock, and I hope you got yours too. So I'm going to go back and answer some of these questions right now. Anvar H also sent me $1.99 super sticker. Thank you so much, buddy. I really appreciate that. So Investing 101 says, I bought some Tesla Leaps last week, feeling so lucky right now. So yeah, so that's, I think you guys watch my video. I'm planning to buy either 1 or 2 Leaps because I was forced to liquidate 200 shares of Tesla because I sold some calls that were out of the money, but not that out of the money. Like when I first started selling calls on my Tesla positions, they were like 20 or 30% above the current price, the strike price, and there was very little chance of them being executed. But I got greedier and greedier and greedier, and instead of making $300 a week, by the time I finally got exercised, I'm making $1,800 a week, on each of those calls. I finally got exercised. By the time I got around to wanting to buy back the stock, it was already like $60 cheaper. I slept in too late. Anyway, so I ended up selling some cash secured puts on that, but selling the cash secured puts took me out of wanting to jump back in the market, wanted to jump back into Tesla, and got me thinking about what are my real ultimate goals here when it comes to Tesla, and it's of course that long-term growth. So now I'm out of those 200 shares. I'm probably going to buy Leaps instead, right? So here's the deal with buying Leaps. Leaps are just long-term calls, but they're already deep in the money. Right, so I'm going to spend $30,000 or $40,000 on these calls. The maturity is going to be 1.5 to 2 years out, and a lot of folks don't understand the way Leaps work, and I understand why you don't understand the way they work, because number one, you may not be a long enough term thinker. Number two, it requires a little bit of math. It requires understanding intrinsic value, extrinsic value, time decay, all of that stuff. And it requires patience, and they're a bit more volatile than actually. So if you're already a Tesla investor, then you're already used to volatility, but Leaps are even more volatile on top of that. That end, eventually, if the call is far enough deep in the money, there's no liquidity for it. So you have to hold on to it until the end and exercise, right? So that is something that discourages people from getting in. What they don't realize, though, is that by the time you get to the end of that 1.5, 2 years, your benefit in terms of owning that Leaps is basically just as good or just a little bit less good than actually owning 100 shares. The difference is I'm spending $30,000 to enjoy the same gains I would have made by owning the stock at basically $108,000, $110,000 or something like that. So well, maybe my math is a little bit off right here, but basically I'm using a third of the buying power to enjoy almost all of the gains in that year and a half if it goes significantly above my break-even point. And the deeper in the money you buy those leaps, the sooner your break-even point comes, right? So if I buy a call at 770 or something like that, and I'm paying a 400 or $40,000 for that, my break-even is going to come pretty quickly. Do I think that Tesla is going to be over 1150 in a year and a half, 2 years? Oh, hell yes, I do. Do I think that Tesla has the chance to be at 2000 in a year and a half to 2 years? Hell yes, I do. In that case, a leaps makes a lot of sense because I'm using 1/2 to 1/3 of the buying power to get the same benefit as owning 100 shares. And I don't know how to express this in a way without drawing pictures. And I do like to draw pictures. I'm just not a great artist, but I don't know how to express this in a way without drawing pictures to more clearly illustrate that. It requires more patience and it requires more of an iron stomach. But in the meantime, I'm going to take that other $40,000, $50,000, $100,000, whatever I end up not. So I'm not buying $200,000 in stocks. I'm going to buy $60,000 to $80,000 in leaps. I'm going to take that other $120,000 to $140,000. I'm going to invest it elsewhere. The only thing I need to make up here, like I need to do better than the extrinsic value of the leaps. And most of them, I'm not calculating these leaps out 1.5 to 2 years. The rate that I need to beat with that other $120,000, $130,000 essentially needs to be like 2%. I need to earn like more than 2.2% in order to beat on that extra $140,000 to beat what the losing the extrinsic value on the leaps, right? So the downside of owning those leaps, of course, is what you can lose if things don't work out. So let's say I go out and I buy $200,000 of Tesla shares, right? Let's just say they're $1,000. I go out and I buy $200,000 of Tesla shares. The price declines to 760. I have lost $240,000. I'm sorry, $24,000 per 100 shares. In this case, that's $48,000, right? So let's say I went out and I spent $60,000 buying those leaps where the strike price was whatever I mentioned before. I forgot the number that I mentioned before. My loss is limited to just the premium that I paid for those leaps. If I own the shares, my loss is unlimited down to zero, meaning I could still lose more money, right? But let's say the price drops from $1,000 share to $500 a share. In the case of Tesla, I would have lost $100,000, half of my investment, right? But it would have been $100,000. In the case of buying the leaps, I would have lost $60,000. What I bought the leaps for, but my loss would stop right there, right? So as one of the members of my Patreon made this point today, this is the way of using no recourse leverage, right? There is no recourse beyond what you paid for in premium costs to obtain those leaps. In order to use leverage, right? Normally, if you want to use leverage, you have to borrow money, and if the price declines in that stock, then you owe a bunch of money, and you have to liquidate something else. If the price of the leaps declines below the strike price, you just lose whatever you paid for the leaps. So generally, I don't make this a huge part of my portfolio. It's I consider the leaps as part of my individual securities. So individual securities, leaps, options never makes up more than like 35% of my portfolio, right? But in this case, it's about 10% of my portfolio right now because I'm going long on a couple of other stocks too. I'm going long on Square and going really long on SoFi. So I'm buying. I haven't bought the leaps in Square yet, but I bought leaps in SoFi. And actually, one of the things. So I'm not a big believer in Palantir. I don't think it's necessarily a $100 stock of the next year like some people do. There's this other channel that I watch occasionally. I'm not going to mention it, but the guy just constantly talks about Palantir. And I can tell that he has not worked as a government contractor before and doesn't work in a town where that solely exists, like San Diego, where I live, solely exists because of government contracting. It's not, I mean, yes, it's a large tourist destination, but 95% of the money here is related to the military, related to the Navy, the intelligence services, technology, and all that. And business. So we're just awash in government money and government contracts. And I don't think a lot of the bulls that are really excited about Palantir, the technology is exciting. What you don't realize is that every other company here that's a military contractor or an intelligence contractor. They're acquiring AI firms left and right. They're building anyway. So I don't have as much faith in Tesla or in Palantir as a lot of other people do, but I do think they're going to do quite well. When I look at their revenue growth, I'm not looking at quarter by quarter. I'm looking at the revenue growth over the last many years. And we have a really good track record of revenue growth because they've talked about that quite a bit. But I'm also looking in comparison to some of the other contractors that I've seen grow up in that time period that are now public. And I'll be honest with you, they're not really growing faster than those guys, those really competent guys did from like 2005 on, right? But here's the thing. I don't think it's a $100 stock in the next year. I think there's a good chance that it could be a $45 stock in the next year, right? So here's the thing. I just bought a Leaps contract on Palantir. I think that I bought it with a strike price of 20 and I paid 9 for it, right? So which means I paid $9,000 for a strike price of 20 in a year and a half. Right? I think it's June of 2023 is when it matures. Do I think that Palantir is going to be worth more than that? Yes, I do. So here's the thing. My break even is at $29 a share. Right? So if I've bought Palantir right now at what is it, $26 today, if I spend $2,600 to or $26,000 to buy 1,000 shares, and so $26,000 to buy 1,000 shares, and if I wait long enough for this, and it goes up to 45, you know what I made? I made $19 per share, right? So the difference is if I do the same thing with Leaps, I make almost as much money, but the point is I only risk that $9,000 that I paid for the Leaps contract, right? That's it. If the price doesn't go above that, all I lost was that $9,000. The price goes above that, and it closes above that strike price and above 45, which is where my target is, I made all that money and I only risked $10,000. I can take the other, or only $9,000. I can take the other money that I didn't spend and invest it in somewhere else, put it into a dividend growth fund. I will beat, just on the dividends alone, I'm going to beat that 2% in extrinsic value that I know I'm going to lose, right? So, so very, very important. Leaps are really, really important when it comes to super long-term investments, things that you have high conviction in for a long term. It's actually, buying Leaps on something like Microsoft, you could easily get burned on it because sometimes it goes like a year and a half, 2 years, and it doesn't really move very much in price. And that's kind of the case. But these growth stocks where they either have tons of growth potential or they're going to die. I think that's kind of where the advantage is in Leaps. You can use what Jonathan, and I can't pronounce his last name, Payday or something like that, from my Patreon said that it's no recourse leverage. And that's a phrase that I have not heard in a very, very long time. Anyway, spent a lot of time on that. I'm going to move on here to more questions. So White Wolf says, how long until Legacy Auto goes belly up? I don't see them really going. I was initially one of these guys that said, hey, they're going to go belly up. No, they're not. So they're survivors, man. They're like the Lokis of the Marvel Cinematic Universe. This is what, I wouldn't say all of them, but Ford is definitely the Loki of the Marvel Cinematic Universe. They're the survivors. Many other legacy automakers, remember, they're tied to governments, as well as Ford and GM and all. They're also tied to governments too. They periodically get rescued. But GM is in not terrible financial condition. Ford is in not terrible financial condition. They've put a lot of money towards investing in EVs. And let's remember, they have the best-selling car in the United States, the best-selling vehicle in the United States, which is the Ford F-150. They're coming out with an electric Ford F-150 here pretty soon. It's really, really expensive. But if you guys grew up where I grew up, you saw people that drove $80,000 dualies, who just graduated from high school. People, who spent $50,000 on a car when they had their first job as a teacher, $50,000 on a truck when they had their first job as a teacher. The Ford F-150 as a truck has this huge cultural significance for Middle America, really for all of America. I think that Ford, by going electric, that's how they're testing the markets. They're avoiding pretty hardcore going into that passenger vehicle market. I really think Tesla is going to dominate passenger vehicles, and somebody else is going to end up dominating trucks. Like, I'm going to buy a Tesla Cybertruck when they're available, even though I think it's ugly as hell. But part of it being ugly as hell is what makes it cool, because those flat panels are one of the reasons why it's super cheap and it's only going to cost you $42,000, because they don't have to be stamped, right? You can't, I mean, you can only cold roll steel so thick, you can only stamp steel so thick. And that's one of the reasons this is so cheap, right? So, but it doesn't look like a truck. And I honestly think that the Cybertruck is not going to have the same volume of sales that a Ford F-150 is going to have, simply because the F-150 looks like a truck and the Cybertruck does not. And it's going to turn people off. That crowd does not like new and innovative. I remember when in the late 1990s, when Ford changed the way their F-150 F Series was made, and they went to curves rather than like blocky changes in lines. It caused a lot of consternation. It took years for people to get over that. So yeah. Connor Sullivan says the only EV I would invest in would be Tesla or BYD. So in terms of vertical integration, in terms of how much of their own process they own, I think that that they are the most complete EV companies out there. They can provide almost everything they need themselves. And I think eventually Tesla's going to start making their. I don't know this for a fact, but I think Tesla eventually might start making their own chips. It's something that's been mentioned before. BYD's semiconductor arm, I don't know if it's still in the process of going public or they've gone public on the Hong Kong exchange yet, but I think that they're going to steadily sell more and more and more. They went from not selling very many electric vehicles. And remember, electric vehicles isn't even necessarily the focus of their business, right? Vehicle sales was not the focus of the business. They had a huge business in batteries for, EVs were a thing in China. They had a huge business in electronics long before EVs were a thing in China. That's a large part of the business. The fact that they're selling now, 50,000 vehicles a month is amazing. And it was like 70,000 for the quarter or something like that. But most of those were actually battery electric vehicles, and some of those were hybrids as well. I don't remember the exact numbers anymore. I pulled them up on a video that I did like last week or so. But BYD is kicking the tail off of Nio and Xpeng right now. I do see that Nio and Xpeng are going to be successful, but in terms of the domestic market, they're never going to grab more than 10% of the domestic market. That is simply not how the Chinese market works. No company has ever been able to grab more than VW has, and they have about 14% of the overall car market right now. So I don't think we should be making these one-to-one necessarily connections between what a legacy internal combustion engine car maker can dominate and what a newer player, disruptor can dominate. But I don't think, because of the differences in regional culture, China has huge geographically vast differences in culture between regions, regional competition and pride. I think that they're not going to dominate more than 10% of the market. If they really want to be successful, they have to be successful outside of China, right? Whether or not any Chinese automaker can be really successful outside of China is still up in the air, right? China has never really produced a premium brand of anything that's been exported. And I think that Nio is really their first shot at a premium brand of anything to be exported outside of the United States. Although I think that the Xpeng's product is actually probably better in a lot of ways, especially in terms of technology. And I think that their production capacity, because they don't have this onerous contract agreement with a government-owned enterprise, their Haima production facility is pretty much secondary now to all the stuff that Xpeng is doing on their own. I think that eventually Xpeng is going to start outproducing Nio, and that's going to happen fairly rapidly. There's a couple of other factories. They have 2 other factories under construction right now that aren't even online, and I think they're going to end up outproducing them. And the fact that they started a little bit down market, like they used Tesla's sort of basically used Tesla as a test market to start off further down market in a population that could still afford to buy an electric vehicle, but it's a huge population of people. Nio started off with higher priced vehicles, and now they're struggling to like move down market and compete with all kinds of other folks in there. So anyway, I'm not sure of that, of course, but that's just kind of my feeling right now. I like Nio, but I like Xpeng a little bit more now. BYD, I think, is going to be a solid producer. I don't know why they get so like a lot of people that I speak to on YouTube are really negative when it comes to BYD. I'm thinking is something like, you don't really know what you don't really know. Like when I talk to these people, they're like, oh, BYD cars are crap. I'm like, they don't even know what BYD produces half the time when I ask them. They've never talked to anyone who's been in one of their cars. I know an engineer, and actually it's a VW engineer, and I actually know 3-4 VW engineers who work here in San Diego, and they talked to me about taking apart some BYD vehicles to reverse engineer them, and they're saying that they're, other than some of the quality issues, sorry guys, other than some of the quality issues that are associated with steel making there, the vehicles are just as fine as anything else that's produced there. So yeah, anyway, so Investing 101 says, so happy to catch this stream. I missed it last week. Happy to have you on here, buddy. Let me see here. Gold mine. Just opened my Roth IRA account. Should I buy SPY or VOO? People say that VOO has a lower cost and a better return. Should I buy an individual stock like Apple? So that is a question that's really hard to answer for someone who's a licensed advisor through a YouTube channel. It's actually not really allowed. But if you're comparing two ETFs that ostensibly do the same thing, meaning they're both S&P 500 ETFs, then you would need to go with the one that has the lower management fee. Because theoretically, that's the only thing that's supposed to separate them is the management fee, because they're supposed to have exactly the same holdings. They're supposed to update whenever the S&P updates. They're supposed to make the trades whenever the S&P makes the trades. And that would really be the only difference. So whichever one has a lower fee would have greater performance, right? And that's kind of like, that's actually one of the questions on the CFP exam, like how do you make that recommendation? And in fact, I can't believe I remember that from so many years ago. Or should you buy an individual stock like Amazon or Apple? So that question is unanswerable through a YouTube channel, like responsibly. Like I legally can't answer it because I don't know your tax situation. I don't know your time horizon. I don't know your appetite for risk. And your appetite for risk is something that really can't be quantified just by saying I feel this or I feel that. Like my appetite for the risk is off the charts. And every time I take one of the tests, they're like, okay, man, you're basically like mainlining stocks, right? So and it's because I have a big chunk of money sitting in the bank, and I know that I can use that to, if I lose everything, I can use that to pay my bills for years until I'm back on my feet, right? So that is kind of the difference there. But yeah, so not able to answer that question. Hopefully that helps you out a little bit though, at least in terms of the difference between the two ETFs. It says BYD is boss, but love Xpeng and Nio as well. All going to make us money. Yeah, my only concern is the legal arrangement, which I just can't remember the name of it off the top of my head right now, that these companies have to be public on exchanges here in the US. Under Chinese law, we as holders of Nio and Xpeng ADRs are not shareholders. And I don't know what the Chinese are going to do. The Chinese government is going to do in regards to that. So that does make me more than a little bit nervous, although I'm not selling anything right now. Yeah, so can a investing one says, can a manufacturer like Xpeng that doesn't own battery production be a major player in the future? So Nio does not own battery production as well. They have a battery asset company in conjunction with CATL, which it's not really clear how those finances flow right now when I'm looking at their financials. Xpeng, on the other hand, I haven't heard much as far as what they're doing in terms of battery research and in terms of what they're doing in terms of battery manufacture. But it's kind of like, and granted, Apple or iPhones and cars aren't quite the same thing, but we're moving to a point where they're becoming more similar in terms of what they are. So Apple does not own their own battery manufacturing. In fact, BYD used to make a lot of their batteries. They don't own a lot of that part of their production. Apple's really just a phone designer. Now, I'm not saying that a company that is simply a car designer can ever really compete on margin basis with somebody like a Tesla, and I don't think that they can. And I think eventually BYD is going to figure out some of the manufacturing tricks that Tesla has figured out for everyone else. When I say figured out, they've pretty much shared what they're doing with the entire world. So, yeah. You see, any thoughts on bans of single-use plastics? Yeah, I actually think that in the next 10 or 20 years, this is not going to be a concern whatsoever. I think that California is probably will be the first state to do this if they do this. And I think it's going to be a giant mistake to do it so quickly. I think you can limit it in certain ways and in certain applications and make a huge impact. But bioplastics are a thing, guys. Plastics produced from algae are a thing. They're in the testing stage. Most of you folks that watch my channel aren't old enough to remember some of the things that I remember. Back in the 1980s, you could not get Coca-Cola in a plastic bottle. you couldn't get anything that was carbonated in a plastic bottle until the late 1980s, early 1990s. And it took me a while. I did some research on this. It was because plastics actually weren't strong enough to do it at the time. And it wasn't until advances in plastics came along that we were able to do this, right? So we are still making advances in plastics. And there's a lot of research being done right now on plastics derived from chemicals that are produced by algae that are not petroleum based and that break down a little bit more quickly. So I'm actually really enormously optimistic about this as well. This is not something that I've done a video on yet because it's very chemistry heavy. And I did 1 or 2 videos that were chemistry heavy in the early days, and because I like chemistry, and nobody liked them, nobody watched them, and I spent hours on them. But I might do that in the future when that technology a little bit more closer to being commercialized. So see, AM says this is the year for Xpeng. Next year will be the year for Nio. Well, last year was the year for Nio. That's for sure. This year could be the year for Xpeng as well. GC says I also suck at driving. All right. So Investor J says, do you have any thoughts on Lucid Motors? That would be interesting to hear. Actually, Lucid Motors, Jace, is something that I've addressed a couple of times on here. I think that their avenue for success is very, very narrow. Number one, I've taken a look at their factory. Their labor costs are going to be a lot harder or a lot higher than Tesla's labor costs are. They're a lot less automated, right? Number two, they're starting off in this ultra high end market where your demand can now be satisfied by the Model S. And as someone else in my Patreon group they made this point that not everyone wants a Tesla. Even if everyone has a Tesla, there's always going to be this population of people that just say, just because everyone has a Tesla, I don't want a Tesla. And that's going to be your market, your initial market for Lucid. There's also going to be the people just compare the two and they choose the Lucid over the Tesla. And I think that's going to be more than a few people. But they're entering the market now with a lot more competition. It's not just going to be Tesla. It's going to be a lot of other people there. So, yeah. So anyway, and in terms of their finances, they look okay right now. I want to see them start delivering vehicles. They've been talking about delivering vehicles for quite some time. I think the initial date earlier this year was September of this year. That has come and gone. They have not delivered vehicles. Now they're saying November of this year. I need to see if that's happening. So Nio is also offering insurance, your secondhand car sales, taxi, solar power, e-commerce. They are, like I said, that market is a little bit more opaque. It's harder to value just how much that's going to be worth for Nio. I don't have the same amount of faith that a lot of financial people do that Tesla's driverless taxi is going. This driverless taxi dream, autonomous taxi dream, is going to come true. Now, granted, this is not something they talk about a lot. This is something that Kathy Wood talks about a lot. This is something that actually William Li has addressed a couple of times. I need to see that autopilot is closer to that dream before that becomes a part of my calculation for what Tesla is worth, right? For what Nio is worth. Yeah, there's a couple of other complications with Nio too. My biggest problem with them is they're tied to JAC. And they don't seem to be able to escape that. And JAC, let's be honest, they're a second-rate manufacturer. Now, they made great strides and improvements, but they're a second-rate manufacturer compared to a Tesla or compared to even a VW. So White Wolf says, why would anyone use loans from SoFi when you can get a stablecoin loan from Celsius without interest payments? They can even pay interest on those stable coins. So, White Wolf, you would have to explain to me why someone would give anyone a loan at zero interest. So, and I'm just pulling this back up so I can make sure that this is what you said. You can get a stablecoin loan from Celsius without interest payments. They can even pay interest on those stable coins. Are you putting up collateral to do this? Meaning, are you putting in $10,000 to take out a loan of $10,000 or something like that? Like Coinbase has, like, you put in $25,000 of Bitcoin, you can take a loan against that, right? And you don't get paid, for staking that at this point, but at some point you probably will. But no one's going to loan you money for free. I loan money to businesses. I don't do it for free. I would never do that for free. So I'd need a little bit more explanation of their business model to do that. And not everyone has collateral to put up. And also we don't have collateralized real estate loans using Bitcoin at this point. I don't know. I'm sure people have paid for real estate in Bitcoin or paid for real estate in other types of cryptocurrency. But yeah, so there are many different ways to borrow money. There's many different ways to loan money and many different ways to use leverage. So some are advantageous for some people and some are not so much. But you've made this point more than once about earning interest on earning interest on cryptocurrency. Look, I've got a Coinbase account. I earn interest on my Algorand. I earn interest on my Ethereum too, and the price varies so wildly that there are many folks that will not be comfortable putting up that kind of collateral, right? That swings in value so much. So, what do you think about Jack Dorsey's comment? Hyperinflation is coming very soon to the U.S. So Jack Dorsey is about my age, but look, people have been predicting hyperinflation in the United States since 1994, since interest rates dropped below 6%. Okay. So a lot of you folks are not old enough to remember that interest rates and bond yields have declined almost every year, not with regularity, but the overall trend has been a downward decline in interest rates on fixed income, downward trend on interest rates on loans since 1994. Basically, since about 2000, people have been predicting hyperinflation, and that hasn't happened yet. So hyperinflation or inflation is more complex than simply the government printing money by adding zeros to electronic entries. It's more complex than the United States simply being the only country on the planet that always pays back their debt. And that is literally what supports U.S. currencies. We always pay our debt back. It may be in inflated dollars, but we always pay you back, right? So that is it's more complex than that. I'm going to say that Jack Dorsey's probably wrong, simply because everyone else who's predicted this in the past has been wrong as well. Since the year 2000, there have been many shrill voices predicting hyperinflation, and they've all been incorrect. Inflation has averaged 2.76 to 3%. It's been lower in some years, it's been higher in some years, but within that target range over a 10-year period, any 10-year rolling period like the Federal Reserve wants it to be. The Federal Reserve has plenty of weapons to stop hyperinflation. Paul Volcker is the one who actually proved how to do this back in the 1980s. If you're willing to pay the political price, meaning that whoever is president at the time, whoever controls Congress at the time, if you're willing to pay the political price to end inflation, and granted, they don't actually have control of this because ostensibly the Fed is politically independent, but whoever's in charge of the Fed, if we go through hyperinflation, we see 2-3 years at 10-15% inflation, the first thing that person should do is jack up short-term interest rates, just like Paul Volcker did, to 18%, right? You decrease the money supply, you actually destroy the money supply and bring it back to the United States. You would have to have the political courage to do that. That's why the Fed is supposedly decoupled from politics. They're not supposed to be involved. They're not supposed to respond to politics. They're supposed to have a monetary policy that is independent of fiscal policy, right? Are we still at that point today? I don't know. I hope we are. I hope that if we go through a long period of inflation or stagflation, that we have a Fed chief who's courageous enough to say, yeah, I'm crashing the economy. Regardless of the consequences, I'm crashing the economy to protect the value of the dollar. Paul Volcker was willing to do this. It took balls of steel to do that. He was hated. He caused millions of people to lose their jobs. He caused millions of investments to fail in that time period because he was protecting the overall U.S. economy. So, So anyway, Nick, that is what I think about that. I think Jack Dorsey's comment is, I don't think he really believes that. I think he heard that from someone else, or he's listening to a lot of really shrill voices. So, you like Square and SoFi long term? Who else? Honestly, Epic Hamster. I like PayPal long term as well. Fintech in general is expanding. It's just things are just moving online. And the legacy bank players are kind of being left in the dust. I know a lot of people fear their power, but why wouldn't a Morgan Stanley be a leader in your financial apps? The only company that really seems to have done well, like legacy company that seems to have done well with an app is TD Ameritrade. They have Thinkorswim. It's a great app, but it's not all that popular, right? And I think that's part of the struggle is that attitudes and attitudes are just kind of shifting and changing here, and newer companies are getting a lot more attention in the fintech space, and they're creating their own ecosystems. So that's what I wanted to get into when I'm talking about. And Steven says, "How did you go about finding Nio when it was only $2 a share?" So I was already a holder of Tesla, and I was just simply looking for other electric vehicle companies to invest in. And I literally just saw an article that said Tesla of China, and this would have been early days, and I think 2018 or something like that. Right after they went public, I bought my first lot at like $11 a share, and was underwater for a year and a half on it. And then when it went down to like $1.50 a share, I think I got it at $1.80 a share. I ended up buying a couple thousand shares. I was like, well, I mean, I'm already down this much. I have the money to risk. I think they're going to get bailed out by the government because this was sort of a vanity project for the government at this point. And William Lee's seriously politically connected. I was like, I think they're going to get bailed out the government. So I'll throw a few more $1,000s at this and see what happens. And I just got lucky. But I literally saw an article that said Tesla of China. And I didn't realize at the time that every freaking company in the next couple of years was going to be called the Tesla of China, and every Chinese entrepreneur that got into EVs was going to be called the Elon Musk of China, right? So there are several Elon Musks of China, and I can't even remember all of their names, but yeah. So and so in terms of SoFi long term, here's the deal with SoFi. SoFi could basically turn out to be the Amazon of finance. Square could turn out to be the Amazon of finance, or one of them could be the Amazon of finance, and the other one could be the Shopify of finance, right? And Shopify is clearly not doing as much as like Amazon is, right? In terms of all of the technologies they're investing in. But SoFi already has the ecosystem that you want to take care of your entire financial life. And let me tell you, folks, I'm putting my money where my mouth is. On Sunday night, I started an application to refinance one of my rental properties through SoFi, and it's not done yet, but I'm going through that process right now. And the initial process is really super easy. It's all done online. I need to provide one more document for them, and then my application is complete. They've already sent me some of the follow-up documents, and this is all before I've spoken to anyone at all on there. So super, super easy to do. Link in the description of this, by the way. If you guys want to sign up for SoFi Money, you get $25 in stock. I get $25 in stock. We all go home happy. So anyway, that ecosystem is there. The problem is a lot of people don't know about it. This community who's very interested in stocks, very interested in fintech, very interested in technology in general, we know about it, but it's not us that are going to drive this company. It has to be wider recognition of the brand. Well, you guys know about SoFi Stadium, right? So this February, when the Super Bowl happens in SoFi Stadium and they buy advertising for the Super Bowl, you are going to see a huge bump up in the number of downloads for their app. You're going to see a huge bump up in the number of people that are joining their community, because this is a branding exercise. Now, buying naming rights for stadiums for a lot of companies doesn't result in a great bump up in revenues, doesn't result in a lot of things. Like for an oil company or something like that, buying buying the naming rights for a stadium, or freaking lemonade company, or what was it, an orange juice company buying naming rights for a stadium, it might not make a lot of difference, right? Because they're not trying to establish a brand. SoFi is trying to establish a brand. They have the ecosystem. They need people to trust the brand, and that is what they're doing with the naming rights for the stadium. And I think they're going to create this branding moment where people suddenly become aware of their product. That's going to happen in February. Like I won't be selling calls on any of my, even way out of the money calls anytime around that period. The other big sort of stimulus here that's probably going to happen, or catalyst, not stimulus. The other sort of big catalyst is going to happen with SoFi is, of course, the bank charter. And let me explain this to you and why most people are completely missing why the bank charter is important. Yes, SoFi is going to make money on basically the spread between interest rates, the spread between what you can loan money for and what you have to pay for deposit rates. That's a big deal. Here's the bigger deal that people aren't focused on, and maybe I haven't mentioned this in a live stream: Galileo services. right now, Galileo is a fintech backbone for other fintechs. People use their technology in order to create their own apps, their own websites, whatever, to access financial networks rather than reinventing the wheel. And this is the way things are going in the future. Not everyone's going to write their own technology. You're going to buy, services from Plaid. You're going to buy services from SoFi. You're going to buy services from a number of other companies that I've done videos on in the last couple of years, right? But here's the thing with Galileo. Right now, if you go with Galileo services, and this is your fintech company, you're using Galileo as a backbone, and you want to offer a credit card, there's a number of different banks that you can use and you will use, right? And you're going to go with the one that has has like the cheapest, the best service and the cheapest cost for you. In the future, anyone that wants to use Galileo services is probably going to be using SoFi's bank to issue their credit cards, to handle their deposits, to facilitate their loans, and that's the reason why they want that bank charter, is really because of the offerings through Galileo Financial Services. That is going to cause their business to expand and exponentially. The second, tailwind that we're going into here is we're going to be probably in a rising interest rate environment, and this is always good for financials. Now we see SoFi having millions of more people they can loan to, not just through SoFi, but through the Galileo Financial Services. Millions of more credit cards that they can offer through Galileo Financial Services. People, other companies using Galileo Financial Services. This is why I'm buying leaps on SoFi. This is why I own a crap ton of SoFi shares. This is why I'm doing a lot of things on SoFi. Now, I don't want to seem just like a pumper, so do your own research on this. Don't take my word for it. Read their call deck. Read their investor deck. Read their call deck. Take a look at their growth in revenue. Take a look at their how close they are to profitability. They're not going to be. They probably, if they didn't do any more expanding, they could be profitable probably by first quarter of next year. But they're taking that money and they're reinvesting in other things. They're not going to be profitable for a couple of years. But once they are, you're going to see revenues and profits grow pretty steadily from that point on. Their ecosystem is there. They need people to be aware of them. So, yep, here we go. Any thoughts on Lending Club? They seem to be undervalued compared to other fintechs. Lending Club is so I've had an account with Prosper for years and years. And I think maybe since like 2011. And I just had a little bit of money in it. It makes me a little bit of money while I sleep. It's on auto invest. I haven't looked at Lending Club. They were the same model as Prosper in the beginning, but now they've gotten off of that. You're not allowed to be I think you're not allowed to be an investor in them. So I lost interest in them because of that. So, here we go. Chevy Silver Raider, are you in on Shiba? Thoughts on Lucid? So, all right, man, I'm going to admit, I don't talk about a lot of like meme stuff. And I didn't talk too much about GameStop. I didn't talk too much about AME. But let's talk about Shiba for a moment. It's fun. It's never going to. I don't think never in my lifetime is it going to break $1 unless people keep burning Shiba in like dead wallets. It's never going to break $1 million. I think there's like a quadrillion coins out there, so it's deliberately plentiful. If it reaches a penny, I'll be stunned. Number one, I'll be rich. But everyone will. If you have Shiba right now and it reaches a penny, you'll be rich, right? But the thing is, it's fun. I mean, I put in an initial like $300. It's grown to real money real quickly. I've even stopped looking at my account. And if you guys notice, there's a huge difference in the price at any one time between platforms with Shiba Inu, and I don't know why this is, right? Huge difference between Coinbase, between WEBULL and one other platform that I was looking at. I was looking at all three at the same time. Huge difference in price, right? So there's an opportunity to do some like exchange arbitrage there if you guys are into that sort of thing. I don't know how that would be possible with how slow these transactions are, but very interesting. Let me see here. Are you in on Shiba? Yes, but I am definitely in on Shiba, but it's not a ton. So No Name says Metaverse equals marketing BS. Yeah, you are absolutely incorrect about that. And I don't normally like come down hard on people like that and say you're incorrect, but so the Metaverse is not simply turning into a parallel economy. It's going to be a larger part of the economy going forward. And it's already one of the biggest new labor platforms on the planet. So Roblox alone And look, we don't have any insight into the internal payments that that Epic Games is making to developers. We don't have any insight into the internal payments that Unity is making into to developers using their platform also, or how much they're making. But we do have that when it comes to Roblox, and Roblox, in a lot of ways, I think is always going to be a little bit more limited than the Unreal Engine from Epic Games and from Unity's platform, which I just can't remember the name of right now. But Roblox is on pace to pay out $500 million this year to software developers, to game developers. This is a massive labor platform. Unity is a massive labor platform. Epic Games is a massive labor platform. They're producing billions of dollars in wages for people at this point. If you think the metaverse is BS, you're just wrong. It's already valued billions and billions and billions of dollars. ARK Invest and Global X, and actually there's a Metaverse ETF, META. I'm going to do a video on that pretty soon. But they're estimating that this business is going to be worth $800 billion by 2030, annually, $800 billion in revenue. So we're not going to just be going in there. Basically, video games are going to become your third place. Right now, you go to work, you go home, maybe you go to the bar, or maybe you go out on the maybe you go out and do something in the metaverse, go to the gym, whatever. But metaverse is going to be a part of your life going forward. Professionally, it's going to be a part of your life. It's going to be a part of your life in terms of your leisure, and you're going to be doing business on it and spending money. Now, look, here's a point that I want to make about the metaverse right now, and I'm going to make a video on this too. How do you invest in the metaverse? I've been making some videos on ETFs lately. These are enormously unpopular videos. Nobody wants to talk about ETFs. But when it comes to the metaverse is an analog to the internet back in like 1998. If you were invested in 1998, and you invested in 100 different companies that were .com related, you probably lost money on 97 of those, right? But the other 3% of those companies that did really well, you would basically not even notice that you ever did poorly in that time period, because the other 3 companies have done so well that they've made up for all the failures. The investing in the metaverse is probably the prime case for going ETF and all ETF in this. It's basically just like the beginning of the internet was in 1998. Something is happening in terms of economics in the investment world and technology, but we really don't know what's happening. And something is happening with NFTs, and something is happening with cryptocurrency and digital properties, and something is happening, but no one knows exactly what is going to happen. I think this is one of the best opportunities to have a really, really wide holding when it comes to your concentration in the metaverse. So this META, the metaverse ETF, is the first one I know of that concentrates in the metaverse. I'm going to be taking a deeper look into that. And I've already bought a few shares of that. And I think I'm going to, based on what I see as far as their holdings are, I think I'm going to go a little bit deeper on that. So GC says, I'm not big on any Chinese companies. I've read some of their manifesto and their constitution. Party is greater than capitalist is sign of that. Okay. Well, the Chinese economy is very capitalist. And it's just the government is fascist. They're not communist. If you have a stock market, you can own shares of private property. You aren't communist. I don't know what to call them, but they're definitely not communist. So, what was the big short-term SoFi hit that's going to be very, very good for SoFi in the long term? Oh, that was the acquisition of Galileo. So they paid a lot of money to acquire Galileo. Let me see here. So Jack Dorsey, I assume you're referring to Jack Dorsey. Jack is a Bitcoin maximalist. This hyperinflation talk is part of his Bitcoin to hedge inflation, so that's why you need to buy it narrative. So it's not clear at all that that Bitcoin is actually going to be a big hedge on inflation. It doesn't seem to be related to inflation at all. So, that's not the thesis. Is of course that it is going to be a hedge against inflation. It's still not clear that it actually will be. Can you explain how interest on marginal loans works for taking money out? So I'm not sure exactly what you mean by that. Like, do you want to take money out of your account and do something else with it, or you do want to borrow money inside of your account and buy stocks? So the way it works is you don't have the money to buy something. You want to borrow $10,000 to buy stock. You borrow $10,000 to buy stock. You pay interest on it monthly. You pay buttload of interest on it monthly. It's usually like a 9% or 11%, 9 to 11% APR, and you pay on it monthly. So you got to beat that with the investment that you're making over time, usually somewhere between 9 and 11%. That interest rate on your margin loan is actually going to be variable too. So as interest rates rise, your interest rates, as interest rates rise, it will push the stock market not lower, but it'll restrict its growth. But the price that you're paying for the money you buy is going to rise. So in a rising interest rate environment, I don't want to have a ton of money on margin, right? So I do some cash secured puts in a margin account, which means they're not really secured by cash, is secured by margin. But I never want more than $30,000 to $50,000 potentially on margin. So when I'm rolling my puts out there, I'm doing it at like, further and further out in the money, the further I go, or out of the money, the further I go. And I'm doing that in a way that where I'm never going to have more than $30,000 to $50,000 on margin if I do have to do that. So hopefully they all expire out of the money and I just collect the premiums and don't have to buy the stock. But if I do, I'm doing it on a stock that I want to own anyway. I'm just getting it at a really low price. So, but if you want to take, I had a client who just asked to do this a couple of weeks ago. He took a giant margin loan out, took it out of his account and left. Why would you take a loan on your margin account at like 9% interest when you can probably go to the bank and get a personal loan for 5%? An unsecured one, or even a home equity line of credit or something like. You can do it for a lot less than what you can do on a margin loan. So I don't know why people would do that, but I have seen that before. So tapering in November, I say tapering probably happens first quarter of next year. I also don't think that Jerome Powell is not long for this world, but not long at the at Federal Reserve. I think he's going to get replaced here pretty soon. Not that like the signs are there or anything. Not that I have any inside knowledge of this, but yeah. So China will squeeze Tesla out one way or another. That's going to be complex, right? They've had plenty of opportunity to try and squeeze other manufacturers out of their country completely when they want to do something. They haven't been able to do that. And the fact that you have VW, a foreign car company, a German car company, actually dominating their market. When I say dominating the market, I have about 14% market share. I think that would be an indication they're not really going to do that. It would be hard to do that without retaliation from the United States in some way. It would be hard to do that actually without retaliation from Europe in some way. Also hard to do that when they're making quite a bit of money and there's a lot of high paying jobs at Tesla's factory and they're exporting those vehicles to Europe at this time. Now, once Giga Berlin comes online, I think that Giga Shanghai is probably going to be more focused just on that domestic market there. But they're making an effort to make Tesla Tesla in China, a Chinese company. They're making a Chinese designed car for the Chinese market in Shanghai right now. From what I understand, that project is pretty far along. So yeah. And Moonboy says, will stock tank? At some point, stocks are going to tank. Look, the market's been pretty good for a while. Like the crash we had in 2020 was our last real crash. Everything else that happened since then was just and the crash that happened in March of 2020 is our first real crash in a long time, in 10 or 12 years. And it just didn't last that long, right? You'd made all your money back pretty much by like June or July. And if you were a technology investor at least, and then a little bit later for almost everyone else. So that still was more like a flash crash, and everything else that happened since then in terms of numbers has really been just a minor blip. At some point, we go through like a year-long bear market. When that happens, I don't know. My reaction to that is going to be no reaction. I'm invested for the long term. I can remain solvent for a very, very long time. If you are investing in a way where you're worried about a bear market that lasts for a year, then you should probably invest a lot less aggressively or think about having a much larger cash position to help you through that. If you need your investments to live off of at some point, you should probably think about dialing back the amount of risk that you're taking at this point. So, yeah. Who do you think is number 2 in the race for FSD? Personally, I'm rooting for Xpeng. So I'm rooting for Xpeng. full self-driving, like I said, I'm still not convinced that it's going to happen in the next decade, that we're going to have it approved in the next decade. Now, it's already better than humans in terms of collisions per million miles driven. But I've actually taken a long trip using with someone else in their vehicle, and FSD doesn't do a few things. Like it won't force it can't drive aggressively. If you're driving in LA traffic and you're trying to force a lane change, it ain't happening. We missed 2 exits trying to do this and try to use full self-driving to do this, and it just didn't quite work out the way I want to. And you mean level 5 autonomy? So I don't want to say anything about that until we come a little bit closer to that day. We are not as close as I think most financial people want us to think we are. Yeah. So TS says China will favor Chinese companies. So BYD, Nio, Xpeng, or Li are good bets. Yeah. I mean, just like the American government favors American companies. The U.S. government does not even like Tesla. U.S. favors union shops, GM, etc. Yeah. I mean, that was a pretty deliberate snub by the current administration when it came to the auto industry. But the legacy auto industry represents a lot more jobs than Tesla does right now. And going forward, no matter what, they're going to represent a lot more jobs. It's about votes for them. I think that yeah, I don't like to get into politics on my channel. That's not my thing. I know plenty of people that do, but I don't like to get into politics. So China will just copy Tesla for the manufacturing tech like every other tech. Just wait. So in 2014, Tesla opened up all their patents for public use. When you say copying that, everyone out there is copying Tesla right now. They don't keep their manufacturing techniques a secret. They just ask that you don't make a carbon copy of them. So yeah. So and that's a criticism that the Chinese are getting right now, but I don't think it's a valid criticism. Tesla wants to see wider adoption of electric vehicles. They see their path forward to dominating and becoming a $3.5 trillion company. They see their path forward to that as being wider adoption of EVs in general, and they can't do it all on their own. That's the reason they gave away all of their patents way back in 2014. That's the reason why they're still doing the same thing now. So answering your earlier question, Celsius requires collateral, and you can risk getting liquidated. Okay, yeah, BTC held the line at 40. So yeah, so interesting. Yeah, I mean, so that's no different than that's not really very much different than the banking industry either, right? So there are collateralized loans that you can get from like a regular bank where you put $1 million into one of their CDs and you can take out a low interest line, have a low interest line of credit. That used to be something that was available to businesses all the time. It hasn't been used as much in the last couple of years, but that's been around for a very, very long time. So SoFi is my largest stock position by 200%. Interesting. So the SoFi is not my largest stock position, but it's fairly significant, especially for a new company, for me to dive into it this intensely. This is not something that I've done for a long time, but I know the financial industry really well. I know the struggles that people have creating brand and the struggles you have keeping your clients engaged. And I think that SoFi has a really good flywheel strategy and a really good ecosystem to keep people engaged. So yeah, let me see here. And GC says we have huge demand for the metaverse. We do. Would you do a meetup in a universe, i.e. VR chat? Yeah, I wouldn't mind doing meetups in Metaverse VR chat. I have was it Microsoft HoloLens or something, and I've never even taken it out of the box. My son uses it, I don't. But I would be happy to do meetups like that and to talk stocks, to talk anything you want to talk about. So will the government be able to taper, or will we end up like 18th century France? Now the government's going to be able to taper. If you weren't old enough, I mean, I'm not really old enough to remember what Paul Volcker did. I'm reading this in history books. But Paul Volcker, when it came to tapering, his idea of tapering, he didn't have the tools with it that the government has now, which is they're going to stop buying bonds, right? That's going to cause interest rates to rise. They're providing liquidity for that market. That's one of the reasons interest rates are so low. But Paul Volcker had one tool. He basically had a hammer, and everything to him was a nail. He took short-term interest rates and raised them up to 18%. And made it impossible to borrow money and crash the economy. and use that literally to destroy money. Like when I say destroy money, now you just take a few zeros off a few electronic entries. They were actually receiving money at the treasury and freaking burning it, like literally burning actual dollars to take it out of circulation, right? They raised interest rates so high in order to sell shorter term government securities. Like you could buy, at that time, I think you could buy a short term CD for around like 22% in like 1981 or 82 or whatever, maybe it was 83. But you could even buy like a 30-year bond for 13% in that time period. It was ridiculous. So you could buy a 30-year bond, $1,000, get paid $130 for a year on that bond for 30 years, and then when it renewed, you couldn't get jack crap for it, right? So, and that was the goal, is that you were going to be paid back with you're going to be paid this interest, and by the time we got around to paying you back your principal, we'd taken a lot of money out of the economy. It just simply wasn't, and we had reduced inflation at that point. We have a lot more tools to do that. One of the things we could do really quickly instead of tapering, it's just reimpose to raise interest rate. It's simply to reimpose reserve requirements at banks. Say, now you have to keep 10% of the money that you have deposited actually on deposit at your bank, and you can't loan it all out. That's going to suck literally 10% of the money out of the economy instantly. And it's going to stop it's going to stop a lot of like business lending, and it's going to slow down the economy. But like literally, that's the trick for tapering, is crashing the economy. And do I think they're going to have the balls to do it? They're going to have to. If things go the way that the bears think they're going to go, that's the solution. I don't think that's the way things are going, largely because this has just been a prediction for 20 some odd years now. Do you know why Twilio drops? Do you know why Twilio dropped so much today? I know the market was red, but they took a steep dive. I couldn't find anything about it. Actually, I haven't looked at it at all. So I can't answer that question. And yeah, so I would love to answer that question. Unfortunately, I just don't know about that. And White Wolf, interesting that you talk about 18th century France, though. So 18th century France was literally that was, I assume that you're talking about Napoleon and their problem with inflation. They didn't have a bond program. They didn't have a system to pay the money back. They didn't have any way to control their fiscal policy. He simply just printed money and printed money and printed money and printed money, and didn't think that Napoleon did not understand that when you created a larger money supply that there was going to be inflation. He simply didn't understand it. Brilliant guy militarily, did not understand anything about money. So see. Jason, hear or know anything about Freyr battery stock? Frey apparently teaming up with Koch to build a plant in the U.S. Yeah, you mean the Koch brothers that are in oil? Which long time ago in Corpus Christi, Texas, I worked on a supply boat for Koch, and miserable job, by the way, absolutely miserable. But no, I don't know anything about that. So. Edward Gilmartin says, President Reagan never criticized Volcker the entire time he had rates at 18%. Had to give Reagan points. Yes, because Reagan respected the independence of the Federal Reserve. Our last president and this president do not respect the independence of the Federal Reserve as much as they should. You approve the appointment and you keep your mouth shut when it comes to the Federal Reserve. I think that the government being involved in monetary policy needs to end. And I think it's only a negative for us. So, so that's one of the things. That's my one sort of indulgence in politics today. That's what I'm going to talk about. Want to remind you guys, super chat features are on. If you guys have questions, you think I missed something here, let me see here. Let me scroll back and see if I've got you guys. Looks like I've kind of answered most of the questions here. All right. So anyway, shoot with more questions, anything related to technology, anything related to finance, financial planning, retirement, Social Security. I'm a little weak on Medicare and Medicaid these days, but yeah. So Henry Hens SY says, can you share some thoughts on eVTOL since we know this industry is still in an early stage? So I've talked about this about this a couple of times. This is not something that I'm convinced is really going to take off. I think that in terms of drone technology, I think we're going to see delivery by drones. In terms of selling people flying cars, I think that's not going to happen anywhere in the United States where you have neighbors. There's no way to make an EV toll without pushing lots and lots of air. And I made this point in my last live stream that if my neighbor buys an EV toll, I will sabotage it because there's just no way to make it quiet. You have to move so much air and create so much force to get that thing off the ground. And I think that that's going to be the limiting factor. Is that I think they're going to be high dollar items, high energy use items, and there's going to be a limited area where you can operate them. Is there a wide enough market to say I'm going to invest in this company and this company is going to be successful? I don't think so at this point. I think we need to be further down the line before I invest in something like that. Hey, Jason, what do you think about EV infrastructure investments like Albemarle, BAT, too big to be useful? No, I think that Albemarle is actually one of the better plays. Like, there's a lot of companies in the EV infrastructure space that folks are really excited about, and I don't see that there's a real reason to be excited. Like if you're looking like ChargePoint or Electrify America or any of these other companies, they don't sell anything that's unique. They sell plugs. They're glorified plugs. That's all they are. And when I say there's no special technology there, anybody can make it. And anybody that produces electronic equipment is going to be a producer of EV infrastructure, coming out in the future. So that's not special at all. What's special about Albemarle is that they make a lot of the precursor chemicals that are going to be used in the manufacturing of batteries, as well as, and they specialize in lithium chemicals, right? So if you don't know anything about chemistry, then you don't know that lithium is a highly reactive element, and it doesn't occur in its natural elemental form. It occurs with something else. Like you can't, basically, if you ever thrown sodium, like pure sodium, into water and see it explode, and that's because it just reacts and it bonds with the it reacts and creates fire and explosions. Well, lithium is pretty much the same way. Like you don't get pure sodium in nature; it's always bonded with something else because of how reactive it is. Lithium, you don't see pure lithium in nature; it's always bonded with something else. So Albemarle has long specialized in different types of lithium chemistries. They have the best lithium chemists on the planet, and they make a lot of precursor chemicals for cathode manufacture that's going to be very, very important. So the other thing that's going to be important going forward when it comes to battery manufacturing, is graphene technology. So I think that graphite, silicon, I don't know who's going to win when it comes to the anode technology, but graphene sheets could be a really big player in this. It's been a while since I've done this research. That was my conclusion back then. Maybe I need to look back up at that. But yeah, so GC says, any thoughts on the algo governance vote coming up soon? No, because I did not join algo governance. I couldn't get approved from my compliance department in time to do that. And I don't know that they're going to allow me to do that. So, but I am going to try and figure that out. So back to batteries just for a minute, though. Albemarle is a great investment. BATT, I think, is a great way to hold the battery, have a wide investment battery infrastructure. I hold LIT from Global X. I like Global X's philosophy of disruptive investment, and it's very similar to ARK Invest. But LIT is an ETF that focuses on technology, like battery technology. They have a huge holding of Albemarle. I think it makes up like 14% of their portfolio. BAT is not, Albemarle doesn't even make their top 10, which to me kind of blows me away, because no company makes as many lithium-based chemicals as Albemarle does. So that is the reason that I hold LIT. So let me see here. Investing 101 says, you may want to look at Lending Club business again. Looks a lot like Upstart, crazy revenue growth plus chartered bank status soon. So I will probably take a look at that. Like I said, my interest in that company kind of went the opposite way, like, because I started this Prosper as an investor. I mean, I put in money and made microloans to people back when you could, like, read their stories and read their shop stories and be impressed. And Lending Club cut that off, so I haven't been interested. So yeah. Oh, people in California about to get their $600 state stimulus check October 31st. Yeah, I don't qualify for it. I'd be happy to get it. I don't qualify, but I'm happy that everyone else is getting it, because a number of the people who frequent my businesses qualify for it. They already got, I think, an $1,100 check in July or something, and now they're getting another $600 check. So I don't know if California is the only state giving out stimulus checks, but in 2020, California had like a $77 billion budget surplus, and that's where this is going to. It's a lot of it's coming back. So, Jason, how about EV battery recycling like ABTC? Do you think it will move fast because there's right? So I do think it's going to move very, very quickly, and it has to move very, very quickly. So a lot of what is made in even older lithium-ion batteries, a lot of that is recyclable. The batteries that are coming out, like that are going to make their way here to the U.S., like the lithium ferrophosphate batteries, those are essentially 100% recyclable. But the tail's longer than you might think on this. So the lithium ferrophosphate battery can run about 4,000 cycles before it's not useful in an electric vehicle anymore. Right? A well-managed battery is going to run about 4,000 cycles before it's not useful. Between 4,000 and 5,000 cycles before it's not useful in an electric vehicle. But it doesn't mean that battery is dead. It means that it's about 70% capacity, and you can still put that battery somewhere in stationary storage and use it for like grid storage or something like that. So I mean, look, a lithium ferrophosphate battery that you can get 250 miles of range out of that lasts for 4,000 cycles, that's 1,000,000 miles, right? That means literally that even if you drive 50,000 miles a year, your car is going to last for 20 freaking years, right? Or that battery is going to last for 20 years, which is a huge improvement over the earlier Tesla batteries that maybe lasted 300,000 miles, right? Huge improvement. But it now means that batteries are going to last longer than most cars do. I think the average life of a car is only like 11 years or something before it's wrecked or falls apart, right? So batteries are going to last longer than cars do, and it's still going to have a life after that. Now, some of the more energy-dense chemistries aren't going to last as long. I can't remember. I was reading about something recently where it's roughly 18% more dense than the best the blade battery that's out there, but it's only going to last for about 400,000 miles. 400,000 miles is still well beyond the life of most vehicles. And when I say last beyond 400,000 miles, still has 70% capacity after 400,000 miles. So the tail for recycling batteries is probably quite a bit longer than you think. Meaning we have a lot longer to think about this before we have batteries piling up. But I think there's going to be big money first made in developing stationary storage from batteries. Meaning when you buy an electric vehicle and you go to buy another electric vehicle, you're going to get a pretty good rate for the battery in your car. If your car is like 7 years old, it's still going to have residual value because that battery is going into the grid, right? I think that's the future of EV batteries, is they're going to be reused in the grid. And I think that battery recycling actually comes later. Like this is like a 20-year investment before it becomes big business. That's what I think. So yeah, but no, I think it's going to be big business. I just think it's really far out there. Let me see here. GC says option A is that the current algos distribute per government remains the same, which is around 75 million or 75 million. You can keep allocated to. Oh. Yeah, no, I haven't looked into that. I'm not going to look it up on the cast right now. So, so is buying covered call ETFs better if you tend to move the money out during a market crash or pullback? So, so look, you can believe that you can predict a market crash and when to get back in the market all you want, but I can prove it to you using hundreds of years or hundreds of examples in my lifetime through academic research that you're probably not going to time things correctly. A lot of people avoid the worst of a downturn by getting out a little bit before everything gets really bad. What happens is they never get back in soon enough. So if you should go and read some research called the best 10 days of the market. All you have to do is Google best 10 days of the market. Several major firms have done this research, and they've done it over and over and over like a rolling 20-year period. And they found out that over a 20-year period, if you miss the 10 best days of the market, it usually cuts your return down to literally 30% of what you could make, right? And let me use real numbers here. I still remember everything from the original research that I read in 2006, right? So in that time period, the market averaged 11 from 1986 to 2006. The market averaged 11.8% over that time period. Fidelity did this research. So the market averaged 11.8% over that time period. Fidelity looks back at their accounts and they're like, well, our investors should have done really well because our active managers have done fairly well, and they averaged about 10.3%, even though the market averaged 11.8. Because expenses were a lot higher back then, they thought that was completely justified. When they looked at client accounts averaged 3.8%. 3.8%. So they did tons of research, and they determined that it's almost all related to this one factor. You missed 10 days out of a 20-year period that were the best days of the market because you were out. And the best days of the market tended to happen within 2 weeks of the worst days of the market. But if you missed those 10 days, then it cut the return down to 3.8%. And that was one of the things that, and reading Jack Bogle's book, I don't remember which, maybe it was Winning the Loser's Game that I read back then, basically convinced me that it's very hard to time the market and you're better off being a long-term investor. So buying a covered call ETF is great for creating income. So that same company, Global X, also offers a covered call and growth ETF, which I think is a really good bet. They do this on the NASDAQ and they do this on the S&P 500. And it's a good bet, meaning they're only going to write calls on 50% of the portfolio, so the portfolio can grow as well. And it's tended to move similarly with the S&P 500, but create a lot of income as well. So you're getting about half the gains of the market, plus you're getting that income from those covered calls. When you're looking at the NASDAQ right now, the one which is, I think it's QYLD, that yield is really high at close to 12% right now because we've seen tons of volatility in the NASDAQ. If we go through a period where we're seeing less volatility, you're going to see the spreads on calls collapse, and that distribution is going to decline. If we go through a down period of the market, I think in 2020 it dropped down about $16, $17 a share, still produced nice amount of income because of the amount of volatility in there. But they're rolling those options on that probably on a 60-day basis, right? In order to get about 1% a month on there. So is it better? I don't know that short-term trading, trying to trade around a pullback is good. Like, I'm happy when I have cash during a pullback, but I don't make any special moves because I think the market is going to crash. Because I know that if you pull the money out, you're probably going to miss that best day in the market. And like I said, don't believe me. Go Google best 10 days of the market. Oh yeah, what do you think about the Hertz deal? Just interested. I think the Hertz deal is amazing. I covered that earlier in the cast. Like 100,000 vehicles, like demand's not their problem, right? They can sell all the vehicles they want. I think the Hertz deal says more about global EV adoption, and especially that Hertz is going to be using that for their rental fleet. Not the rental fleet, but they're working with Uber so they can rent these vehicles out to Uber drivers. And I think that is the best thing that could happen to Tesla. That's great advertising because millions of more people now are going to be experiencing Tesla the first time. So I wanted to buy a Tesla I already own Tesla stock. I wanted to buy a Tesla back when the Model 3 came out. I went for a test drive. I was blown away by the Tesla. And I was like, do I want to spend $40,000 on a Tesla, or do I want to spend that money on stock? So I spent that money on stock, right? Not all of it. I wish I'd spent all of it on stock, but I spent what I was going to put down on my Tesla on stock instead. And I'm very freaking happy that I did that. I still don't own a Tesla, but now Tesla is going to pay for my Tesla Cybertruck whenever that Cybertruck comes out, right? So I think that this is only good for Tesla, that more and more people get to experience what it's like to be inside of a Tesla. And so, yeah, I think that's amazing. Hey, so GC, like I looked at governance. GC, I looked at governance for Algorand when you sent me the original link. I just haven't looked at it again. I did buy a bunch more Algorand though. Julian apple pies, worth the try or overrated? Overrated. Definitely overrated. But Julian is worth the drive. It's a nice drive up there. Spend a weekend or spend an evening up there. Rent an Airbnb up there. It's actually a nice Lake Kilimak up there. You can fish for trout, hang out, have a good time. There's tons of great hikes up there, but the apple pie is kind of overrated. They had a good barbecue spot. I can't remember the name of it. Do you think the new sodium-ion batteries by BYD will be a viable product? Yes, I do. So energy densities for sodium-ion batteries are a little bit lower than lithium, but the advantage of sodium is it's massively more abundant than lithium is, and it's much easier to mine and extract, and it's not that much lower density. And as battery technologies improve, we're going to see sodium-ion batteries here in the next 5 years that are just as dense. And as lithium-ion battery densities improve, we're going to see lithium-ion batteries get much better than they are today. And we're going to see sodium-ion batteries have energy densities approaching what our mid-range batteries have today. And it's going to be super cheap, right? And the chemistry is mostly already worked out because of all the research done on sodium-ion batteries. So I do think they're going to be commercially viable. I think that sodium-ion batteries are going to show up in all kinds of lower density applications. I think that it's worth investing in that. I even think that it's going to make an appearance in cheaper vehicles at some point. That may be a little bit further off in the future, but the fact that you might have a watch or a phone powered by a sodium-ion battery, I think that's going to happen pretty rapidly. Yeah, so that's one of the things that I when I researched this subject a few months ago, is that when I was looking at the chemistry behind it, it wasn't exact. So the chemist is going to get pissed off when I say this, but it wasn't exact. But a lot of times you could just substitute sodium for lithium in the actual chemical formulas, and you would get a similarly energetic reaction. I know I'm going to get an email from a pissed off chemist now, but that was my reading of this. And I asked a couple of chemists, and they're like, "Yes, you're right, but here are the qualifications." Anyway, so there are some things that are not worked out with that, but very, very happy. So, Jason, I'm interested in the leap show you suggest, or leaps. I think you suggested you might do. I'm interested from a novice options trading perspective. I would like a tutorial show. I think I'm going to do a tutorial on this. There's actually lots of good tutorials out there. And I kind of avoided doing things that other people have done for a long time, but a lot of people have been telling me lately, just do it anyway. Like if not everyone likes me, but if you do like me, maybe you want to hear how to trade options from me. So I might do something like that as well. Nicholas Moran says, thank you for all your valuable insights. Thank you for always supporting my live streams and coming on and commenting. So don't you think that Tesla is way overvalued? Price of sales equals 30, price of sales equals 20. They're both overvalued by traditional metrics, Nicholas. Like you're not investing. So you think the way I do, right? So typically when I evaluate a stock, I do it in a real professional way. And price of sales at 30 would be something I'd never invest in if it wasn't a Tesla, right? I would never look at say GE and say price of sales at 30, I'm in, right? No, I wouldn't do that. I wouldn't even look at say like a 3M and say price of sales at 30, I'm in. I'm not, or even a Caterpillar, I'm not doing it. These are all companies that still have tremendous potential for growth, but they're not Tesla. They don't have the potential for exponential growth in all of these different sectors. They really don't. So, yeah. GC says, how long did you buy Shiba? It wasn't that long ago. So I've made, I made quite a bit of money, but I'm not like a millionaire based on $1,000 of Shiba, if you're asking that. So I didn't make $1 million, but I actually literally paid an employee this month with what I made from Shiba trading. So, but I need to tell him that too, by the way. Yeah, so I don't like meme coins. I don't like meme coins either, but and like I said, I just did it for fun. Investing 101 says, I wish I had a mentor. I burnt too much money learning options. So I didn't trade any options until I had been, so I never buy like out of the money calls and hope that they're going to be in the money. Never do that. I never do that. I'll buy an in the money call, like a Leaps, and wait for a year and a half, and then it's good, right? But most of the time, people, when they get burned, they're selling naked options, or they're buying way out of the money calls instead of selling, or way out of the money options, or instead of selling way out of the money options to create a little bit of income, or using spreads or using straddles or something that's going to limit your loss. That's how a lot of people get burned, right? And I didn't start doing any of that stuff until after I'd been in the financial industry for over a decade, right? So you're not alone. 80% of options expire unexercised. And it doesn't, and it literally means that 80% of the people trading those options are actually losing money, right? And I know some people think that's not the case. But no matter how many times it changes hands, unless things go perfectly, at least 80% of the people are losing money at some point before exercise period, right? And I'm saying they're not realizing that loss necessarily, but at some point they're losing money, right? And that's kind of the gamble. If your chances for a loss are so high, by owning one, you're better off selling options in any case, even like cash secured option or cash secured puts or selling covered calls to limit your losses. You're giving up some of your upside, but I really like cash secured puts. It's a much better interest rate than you're getting on cash, and especially if it's a stock that you think you want to own, right? So, for example, even if I want to buy something like Realty Income, which is a real estate investment trust, I'll buy a cash secured put at $1 or $2 below the current price, sit on it for a month. Maybe I'll get paid $65 or something like that. But when I look at that, that's 1% I'm making in a month. By owning that stock, I'm going to make a 4% dividend per year. But whereas I'm getting 1% for, or a little bit less than 1% just for thinking about owning it. So a cash secured put, when you want to get into a stock, is really not a bad idea, especially if it's a stock you already want to own. You maybe want to own it long term, but maybe you should get paid a little bit just for thinking about it and get in at not only a lower price than today's price, but remember the premium that you took out actually makes you have to take that into account when it comes to your cost basis too. So meaning your cost basis is a little bit lower. So if you think about it, it's a good way to go even with your long-term investments. I want to buy 1,000 shares of Unity. I'm going to buy cash. I got $14,000, but I'm still going to buy a cash secured put at say, at say 139. So I can get it for $1 less, but I'm going to get paid, $100 in the month that I'm waiting. So it's really not a bad way just to invest, right? So and like if you're doing it close to the money like that, and you have the confidence, you want this to be a long-term hold anyway, then do you really care if it goes down a little bit less than what you paid for it based on your put option, right? So Doug B says, any opinion on Alaskan Junior Graphite Miner GPH? No. I don't have anything to say about them. So, and Investing 101 says, I started trading options 1 year in. That's more common than you think. And it's especially become more common with YouTube. And like I said, the short-term trading culture is absolute trash on YouTube, and it will cause you to lose money. It's one of the reasons if you're gonna do options, I advocate selling options and doing it very cautiously and not getting too greedy. And part of the video I made earlier today was to explain that I got greedy and I got burned. That's what happened. I've been doing this for years and I still got greedy. And like I said, it was hindsight bias that led me to it. I was like, well, this worked last week. This worked 3 weeks ago. This worked for 9 weeks in a row. I can't get burned. So I was happy with $300. Maybe I want to make $400. I think $600 is better. I got literally the point where I'm $1,900, $1,800, $1,900 for 1 week calls at what I thought was $60 over current price. I thought I was safe. I was not safe, man. I got burned on that. And then by the time I noticed, I was even further in the hole. So don't feel bad about that, man. Like I'm super experienced and I still got burned by that. So let me see. Some are very easy on looking at volume to spot front running. Got it. Okay. I'm not sure. I'm having trouble following your thought process there, GC. All right. So Hiker Dave just sent me a period. Thanks, Hiker Dave. So some are very easy looking at volume spot front running. Once again, not sure what you're talking about. Anyway, I am starting to get a little hungry here, guys. So I think I'm actually going to cut this one. Actually, I'm not cutting this short. This is about what I do every time. It's about 1 hour and 45 minutes. You guys have been great. Look at the freebies in the bottom. If you don't have a WEBULL account, sign up for a WEBULL account. Robinhood is conspicuously absent in there. I know that. That's because I have an issue with Robinhood. Also, I just put up the SoFi link. So go ahead, and if you don't have a SoFi account and you want to sign up, please use my affiliate link to do that. think about joining my Patreon. It's a great group of really, really intelligent investors. And I get a lot of things to talk about from my Patreon group and from the Discord chat. They don't even know that I'm always there, but I'm there kind of paying attention a couple of times a day. So yeah. So anyway, thank you very much. And I will see you folks next time.